We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Alasdair Macleod, author of the Macleod Finance Substack. Alasdair, thanks for joining me again. How are you?
I'm very well. It's my pleasure to join you. Thank you, Tom.
It's always a pleasure to have you, Alasdair. And I want to start by asking you, we're speaking today on January 21st, of course, the day after Trump's inauguration. And with him now in office, how do you think these factors really weigh out in gold's favor at this time? Obviously, we've seen much stronger dollar since the election that can be a headwind for the gold price, yet lower rates can act as a tailwind. So how do you see, let's say, these major factors stacking up on one side or the other?
Well, it's interesting because the day after his inauguration, gold is actually taking a jump up. I mean, it's up, 1.25% today. Not huge in the scheme of things, but I think where it's going, it's certainly pointing in the right direction as far as the bulls of gold are concerned. I mean, all the executive orders and everything else, that sort of is just so much noise, that it's rather hard to lose, if you like, the main point. And the main point is that Donald Trump is an inflationist. Of that, there is absolutely no doubt. And that is, I think, the vote that foreigners have taken, which is why gold has gone better today. And also, presumably, to an extent, vote that the futures markets, like COMEX in particular, the participants there have taken. So I think we should be guided by that, if you like, in terms of, really what he means. Now, having said that, I would say that as an inflationist, that is obviously very, very bad. I mean, it's common with all politicians. All politicians think that, interest rates should be far lower. And, Fed, why aren't you doing your job lowering interest rates? Is a sort of question, if you like, that gets thrown by every president, let's face it, every prime minister, it's a common sort of political get out. I think there are very positive things, though. One is that he's climbing down from this climate change thing, which I think is desperately important because this idea of doing away with fossil fuels is economically destructive. I don't mean just for the profits of oil companies, gas producers, whatever. I mean from the point of view of the broader economy. If the broader economy hasn't got energy, nothing works. So I would take that as an enormous positive. I'm not going to get drawn into the climate change thing, other than just make observations. It has wrong-footed very much, if you like, a lot of the rest of the world who are both, sort of all for doing away with fossil fuels, all woke, and all the rest of it. And this is going to be a major, major influence, I think, in global politics, particularly when it comes to Europe, who have just lost their way completely. Britain has lost its way completely. We've got a far left socialist government with a sort of schoolroom socialism of the 1930s in mind. That's all they seem to know. So they're being doubly destructive on the UK economy. But I think this sort of drill baby drill thing that Trump is insisting on, I think that is going to turn political mind quite a bit. And hopefully a lot of these deadlines that we've got, like by 2030, no more this, no more that. On that basis, I think these deadlines, probably what the politicians will do is they will just sort of push the deadlines out a little bit, rather than climb down completely, because they're socialists, which Trump is not. Inflationist, but not a socialist. So I think there are good points here. But the one thing that he and I guess Besant doesn't really understand is economics. his statements on trade tariffs, I think, are particularly worrying in the context that if he does pursue these policies, and I don't know, he may come to some accommodation with China. I mean, he's talking to China, which is a very, very good thing. But on the face of it, if he does come up with tariffs against China and against the EU, I think that opens the way for them to raise tariffs against American goods. And then we're talking about a potential Smoot-Hawley rerun. And Smoot-Hawley was very instrumental in creating the Depression in the 1930s. That's not good. It really is not. And about being an inflationist, I mean, I think that the budget deficit is not going to come down under him. I mean, I know that the ambition is to replace income taxes and corporation taxes, at least to a degree, with income from tariffs. But I suspect that, with a sort of switch in taxes, you'll see that the deficit will rise first before the benefits, if you like, of lower income tax and corporation tax comes through in, greater tax volumes. And the other thing is there's this general assumption that the US economy is growing. It's not. I mean, I've just looked. I don't know if many listeners to this are aware, but the Congressional Budget Office updated its 10-year forecasts for the US economy on the 7th of January. And in that, you can see that they expect GDP in the current fiscal year, which runs to September this year, to increase about 4.5% compared with last year, to September 24. Now, when you look at the government budget deficit, that's going to come in at over 2 trillion, which is roughly 8% of GDP. So, you have to look at, GDP growing 4.5%. Why is it growing 4.5%? Because it's getting an injection of over 2 trillion out of thin air, an inflationary injection, which is not being invested in production to produce consumer goods. It is therefore inherently very, very inflationary. In other words, what it'll do is that extra injection will lower the purchasing power of the dollar. And it also means that if the CBA's forecasts are right, then what we're looking at is a contraction of the private sector activity in the region of about 3.5%. And that's a long way from, all the macroeconomists saying, well, this is the economy is growing rapidly and all the rest of it. I mean, they got it totally wrong because they don't understand how these figures work. I mean, I discovered this a long time ago when I was a broker, and Gordon Brown was he was the first Labour Chancellor after the Conservatives had sort of lost it under John Major, and he was continually surprising markets by announcing higher than expected GDPs. And when I looked at it, what it wasn't the private sector, it was the public sector spending that was doing it. He was increasing public sector spending, and that was where the growth in GDP was coming from. The reality is that GDP doesn't tell you anything other than the volume of credit which is being deployed in the economy. It's how that credit is deployed that really matters. Mm-hmm. So we've actually got to revise our thinking, I think, as to what the US economy is doing, ignore what the macroeconomists are saying completely, and apply the same arithmetic to the UK, which has got a large budget deficit. France has a budget deficit of around about 6.5%, 7%. And this is, if you look at all these sort of G7 countries, they're basically that all governments are in deficit. And they're doing so against a background of debt to GDP in excess of 100%. I mean, Germany is about 60%. Canada depends how you count it. If you look at the IMF figures, they say something like 49%. But if you look at other figures, they say it's 100 and something. I don't know where, I suspect there is a difference between federal government and, the various, components like British Columbia and so on and so forth. But we have a debt problem. And of course, the other side of debt is credit. Mm-hmm. So if we've got a debt balloon, we've got a credit balloon. And that also has consequences. And I'm sure that's a topic we ought to cover.
Well, before we get to that, Alasdair, when you say that Trump is an inflationist, what specifically, like, what policies, let's say, do you mean that are inflationary, right? The idea of the Department of Government Efficiency going after and trying to reduce the budget deficit seems, on its face, seems like a good thing. How effective they're going to be is yet to be seen. If we're able to drill, baby, drill and decrease the oil price and flood the market with cheaper energy, that seems to be a good thing.
Yeah.
So what do you specifically mean by him being an inflationist?
Oh, I'm looking at it from really 2 points of view. Oh, and incidentally, when it comes to Vogue, I understand that Vivek Veeraswamy has already resigned. Mm-hmm. So,
I saw that yesterday too.
So we're down to Musk. And I just, looking at that specifically before I answer your question, Musk is going to have to fight the bureaucracy. Now, if you were a betting man, who would you bet on? I would bet personally on the bureaucracy. Your bureaucracy always wins. They know how to look after themselves. Musk is a private sector entrepreneur. Brilliant, absolutely brilliant. He's wasting his time doing this. I mean, really, I don't think that the Doge will last more than a few months, 6 months maybe. He may manage to do something, but basically the spending actually comes from Congress and the Senate, not from an independent department. Mm-hmm. It's as simple as that. Anyway, why is Trump an inflationist? Okay, well, let's look at the consequence of Trump's, that most beautiful word, Trump's tariffs, the most beautiful word, as he puts it. Basically, that is the Trump. The tariffs are paid by U.S. consumers, so that's going to add to the inflation. Consumer price index will be rising at a faster rate because of that. And the other thing is that if you look at, as I was just saying, the consequences of spending, I mean, he's going to have higher spending before it comes down. I think that's the plan. I mean, particularly if you take Doge out of it, then that is an inflationary. He is an inflationist. He is not looking at, cutting anything other than taxes, really. And the rest of it is... it's too late for him to be doing what he's doing, unfortunately. Mm-hmm. That will drive up interest rates, and that's what we're seeing. Now, okay, bond yields have come down a little bit in recent weeks, or in the last week or so, but that's a quite normal consolidation of earlier rises. They're going to go up. They're going to go up higher. And as I understand it, the sort of expectations for interest rates in the States is there will be one more cut later on this year. No, there won't. It's not going to happen. So market anticipation has got to change. Now, it's against this background, we will see the 10-year US Treasury yielding more than 5%, I think within a month or two at the outside. Now, if you look at it in the context of stocks, stocks are now more overvalued relative to bonds than they have been since Volcker changed the whole landscape by raising rates to 20% back in 81. They are the most expensive. And from my experience of these past cycles, of sort of bond yields and the relationship with equities. At the end of an equity bubble, bond yields have already started moving up, but it's the second move up which kills the equity bubble. And that's what we've got. And what we're looking at this time is really, it's not just equities. It's a huge, great credit bubble, which is the largest, I would say, that we have ever seen in history, because it's dollar-based and therefore global. Mm-hmm. It bursts and it takes everything with it. It's going to be very unpleasant.
So with this current strong dollar, Alasdair, and if it does get stronger, how does this affect really the rest of the world at this point?
Well, obviously, you've got emerging economies, so-called, where they have debt, and some of them got huge, great debt. It's all in dollars, so they will be squeezed by this. But more importantly, the policies of the ECB, the Bank of Japan, Bank of England, are completely wrong-footed. They've been praying for bond yields to come down. If they rise, which I'm absolutely certain is the case, then it's just killing their currencies. And you already see this. I mean, if you look at how the euro has performed, how the yen has performed, and all the rest of it, I mean, they've been virtually in a state of collapse against the dollar, even more so against gold, which, of course, is real money as opposed to credit. Currencies are credit. You talk to modern economists, they will deny that. They will say, no, gold is no longer in the system, so the dollar is now money. No, it's not. It is credit, because just look at the Fed's balance sheet. It is a liability of the Fed into the general public. And for every liability, you've got a credit. Mm-hmm. It is a credit. The currency is a credit. It's not real money. So with that, which I would define as gold, metallic money with no counterparty risk. In other words, gold in possession. So, this really is, I think, a very dangerous situation for all financial markets, because when you get this a credit bubble of this size imploding, it takes down equities. It'll take down derivatives, which are huge. It also takes down property, because collapsing credit basically leads to higher real rates, whichever way you look at it. And initially, I think mortgages are going to be unaffordable for increasing numbers. And it's not just in America. I mean, we're looking at, places like the UK, Sweden, where I was earlier last year. I had a day with the Riksbank, the central bank there, and it was clear from my conversations with them that they were concerned about the level of indebtedness in the mortgage market there, and I think they're right to be so as well. So all around Europe, I mean, there's some countries more than others which really do depend on property ownership, residential property ownership. It's going to be extremely difficult, I think, for them, because they'll be faced with having to raise interest rates, killing the private sector completely, which is all based on a bubble now, in order to protect the currencies. Or do they let the currencies slide? I mean, I reckon that the outcome will be that the currencies will slide. But, you've got the problem. How are you going to fund all this debt? How are you going to fund the debt that's being rolled over? How are you going to fund the 2 to 2.5 trillion in the current fiscal year in America, and refinance the what? Something like 10 trillion coming out, which needs rolling over. This is going to be extremely difficult. Not a time to be in credit. I would say get into real money, far safer.
So because of that, let's say that market structure, Alasdair, does that inherently mean that yields are going to need to increase to a point that it stifles, as you said, the private sector to facilitate being able to refinance that debt? Is that what you're
Let me explain it this way. I mean, the purpose of an interest rate is not to try and manage an economy. This is the mistake that central banks have been doing, and led by the big boys. for too long now, which is why they never succeed in what they're doing. What an interest rate is, it's a compensation for a holder of the currency. And this is particularly the case with a fiat currency. If a foreigner looks at the dollar and thinks its purchasing power is going to decline by, let's say, 5% this year, which I think is probably under-egging it, as it were, then the foreigner is going to want compensation for that loss of purchasing power if he's going to buy dollars and hold them for a year. Mm-hmm. So he's going to want that and probably a premium as well for taking the risk. So even on a 5% decline in the purchasing power, he'd probably be looking for something like 6% minimum in order to compensate himself. Mm-hmm. If, let us say, instead of 5%, he expects the purchasing power to decline by 10%, then he's going to want to figure more like 11, 12%. In other words, the interest rate and rates on bonds rarely reflect the prospects for a currency's purchasing power. That is the key thing to understand, and not as a tool for management of the economy. Therefore, as the credit bubble pops and you see lesser forms of credit, like lesser than currencies, you've got things like mortgage commitments, you've got equities, you've got bonds and other financial instruments and all the rest of it. Their value goes down. They are lesser ranking than just pure cash, dollars cash. It's going to undermine dollars cash, because you just got to get, you're just going to, as a foreigner, you're just going to get out of the thing unless you are compensated for your assessment of the loss of purchasing power that this situation is going to give. Mm-hmm. And we all know that what happens under those circumstances is that the Fed will come in and try and rescue everything by reducing interest rates. So what do? I mean, the prospects are that the purchasing power of your dollars is going to go down considerably quicker than you're going to get compensation from the rates set by the Fed. So you sell it. And this is why the Fed is in a cleft stick. It's got a problem. If it wants to manage the economy, then it's going to trash the currency. If, on the other hand, it protects the currency, it trashes the economy. Mm-hmm. And this is what happens at the end of a credit bubble. And I think, it's fascinating, because if you go back to 1920, 21, the depression or the slump in America and previous slumps, the attitude from the political class was, well, we can't do anything about this. We just got to let it sort itself out. And if anything, jack up interest rates, because if credit has got risk, then obviously the interest rate has got to rise to compensate for that risk. Jack up interest rates, let the whole thing sort itself out, stand back, and sure enough, that recession, the post First World War recession from 20 to 21, lasted about 15 months. It was deep, nasty, quick, over. Then you had the interventionists. You had Herbert Hoover, and you had you had Roosevelt following him. They were interventionists. And what happened? You had the collapse of Wall Street. Wall Street started sliding the moment the Smoot-Hawley Tariff Act was passed in Congress, and you then had a recovery. But when Hoover then signed it into law, which I think was something like April 1930, the market started its long decline. Mm-hmm. So you had the credit bubble, which sort of set the thing up. But, what they were trying to do is they were trying to rescue the economy. They're trying to sort of support farmers, do this, do that, and of course, Smoot-Hawley meant that foreign competition was being kept out so that, the farmers would actually get decent prices. It basically screwed everything up from 1930 through to, sort of Hitler rescued us by driving us into war and creating war spending. Not good spending, incidentally, But you can see that was really where the depression ended. I mean, it was brutal because government intervened. Government just kept on screwing things up. And they've been doing this. I mean, I mentioned Volcker earlier. Ever since, shortly after that, the mid-'80s, we've had bubble after bubble after bubble. And what's the Fed done? It's rescued everyone from the effects, if you like, of the malinvestments. Zombie corporations overloaded with debt were rescued. So you didn't have that sort of washing out. You didn't have the creative destruction that Schumpeter described. And so consequently, each bubble fed into the next one. And, the whole situation has just got bigger and bigger and bigger. I mean, do you remember in the sort of, after 2008, 2010, the fashionable phrase, well, they're kicking the can down the road. Nobody's talking about that anymore. Mm-hmm. How are you going to kick the can down the road from this one? I mean, this is too big. It's a tsunami, which is going to completely wipe out markets, in my view.
Mm-hmm. Alasdair, how does this, let's say, the order of operations pan out here? Like what order do these countries, obviously, we talk about the world in a very US centric way, but, does Europe start to falter in this credit bubble first, or, Japan with its, very, very high inflation rate or managed currency versus the economy, as you put it? Are there particular pockets of the world that are more susceptible to this credit crunch than others?
Well, there always are, is a short answer. But this is fundamentally a dollar-based bubble. Mm-hmm. The reason it's a dollar-based bubble is that the dollar is the reserve currency of everybody. It is the international trade currency. It is the international commodity settlement currency. It is the international currency, full stop. So we see the dollar going higher and higher, higher, because people are now waking up to this interest rate problem gradually. I mean, there's still a lot of waking up to do. It's undermining the other currencies. Mm-hmm. We now get to a situation where, as I suggested, if we see the 10-year maybe go over 5% yield, which I think it will do in the not too distant future, then I think that will take the equity market out. Then, of course, all the debt problems in other places will start being triggered as well. Bear in mind that the G-SIBs in both Japan and the Eurozone have debt to equity ratios, in some cases, of over 20 times. Now, that is exceptionally high, and that's come about principally because of negative interest rates. I mean, the only way in which a bank could protect the bottom line was increase its gearing, because the lending margins were just getting compressed and compressed and compressed. So that's what they did, and they're now left with this sort of enormous debt to equity levels. In America, I guess it's around about 13.5, 14 times. Amongst the big G-SIBs, this is. Regional banks are a different story. Now, the normal level at the bottom of a cycle, in other words, once all this is sort of washed out and all the rest of it, is for these banks to have debt to equities of around about 7, 8 times, maybe slightly less even. So it's quite a long way to go, as it were, in terms of bank balance sheets adjusting. Mm-hmm. The problem they have is the only way in which the complete banking system can adjust its total outstanding credit is through their customers going bankrupt, because that's the only way it gets wiped out. Some of it, I mean, the difference, you've got to sort of understand that money supply is actually sort of a secondary consideration in this, because money supply is distorted by flows between the commercial banks and the central bank, because central bank, the deposits, if you like, the reserves, as they call it, which are really commercial bank deposits at a central bank are not included in the money supply calculation. So banks can increase their reserves, and that undoubtedly is going to happen because the Fed will go in there. It'll have to buy bonds because the foreigners and everybody else on the margin isn't going to want to buy anything other than very, very short-term debt. So at some stage, we're likely to see QE come back. Now that will contract money supply, because what happens is it doesn't destroy the credit; it just migrates from commercial banks into the Fed. Other than that, the only way in which this credit gets destroyed is basically when through defaults. So that's going to happen big time. Now, the value of credit, the total value of credit, will diminish because you will have losses booked to, sort of market losses on the value of credit. And that is really the way the adjustment's going to happen. It's going to be mark to market, if you like, in terms of looking at equities, in terms of looking at other financial investments, if you like. And as far as gold is concerned, of course, it will lose mark to market value. I'm talking about the currency losing mark to market value against gold. So this is why gold appears to be going up. It's not. Gold over long periods of time, going back even to Roman times, the prices in many things were really quite similar. There is some fluctuation, yes, but it's pretty minimal. Like it might double or it might halve, sort of thing. This is individual things, but basically, if you have a sort of a broad-based index of everything, measure it in gold, it'd be, it doesn't change. Mm-hmm. What does change, and this is where everybody gets it wrong because they account in these paper currencies, what changes is actually the value of the paper currency. And this is why when we see gold going up, it's really reflecting the fall in the paper currency. But because so few people realize this, they will begin to realize it at a later stage. The thing that's fascinating is if you look at ETF demand, if you like, as a measure of sentiment in Europe, ETF demand for gold ETFs, physical gold ETFs, is pretty much negative in Germany. It's just not increasing. Also around Europe. And if you talk to the retail markets, and I think this is also true in America, you find that people who are hard pressed are selling gold and silver coins because they got to put bread on the table. There's a lot of that going on. So,
well, that's something I did want to ask you about, Alasdair, is this idea, or really kind of, let's say, segregating the gold industry, as it were, into these different parts. We see the futures price or physical, let's say, gold going up in price.
Yeah.
But how are the ETFs responding, and also any equities that are related to gold? How are those also responding? And
okay,
how do you see that separation of these, let's say, these three categories?
Well, I would say that the futures and forwards markets are doing what they should do. Basically, it's speculators taking a view on where the price is going. They're looking at it. They are inevitably looking at it as gold is going up because you're accounting in dollars or whatever. Okay. The answer, as far as physical markets are concerned in the West, is that sentiment is very poor. Nobody's really bought into this. They really haven't. If you look at sort of total, sort of portfolio exposure, it's probably less than 1% is exposed to gold. Now, given that gold is real legal money, that's an extraordinary situation when there is so much risk around with all the debt and everything else. It's bizarre. A lot of it is due to the fact that the Americans have run a very successful propaganda campaign trying to remove gold from the financial system. And so for the last 50 years, people have sort of people have come to believe that rather than the reality, the common law reality, plus the accounting reality, the difference between money and credit. So the sentiment just isn't there, and we're beginning to see a little bit of demand coming for ETFs now. I think that demand, I mean, we're seeing it more in America than we are in Europe, but I think that demand is from investment managers, big investment managers, who are not necessarily buying into the concept of gold, but see that the price has been rising, etc., etc., and this is something which makes sense to include in a portfolio, if you like. I'll put it no more strongly than that. So I think we're seeing that sort of advanced institutional demand. I mean, what tends to happen with a bull market, if we can just think in those terms rather than the true terms of the relationship between gold and credit, what tends to happen is that you find that the speculators will begin to drive up prices first. You will then find that more serious players will then get in on the bandwagon, and the last people to play are the public, because they will have seen that something has risen and it's risen and it's risen and it continues to rise, and therefore you've got to buy it because it's obviously rising. It's obviously rising. This is the place to be, particularly if everything else is not looking good. So we haven't got that ETF thing, if you like, virtually at all, except for a few institutions who are beginning to adjust their portfolios. And I think that probably sums up the current situation.
Alasdair, when you're saying that speculators start to initially drive the price up, obviously we can't discount, let's say, the Bank of China and their central bank demand over the last 2 years here, and how thoroughly they've come into the market. So is that, do you classify them in some ways as a speculator, or because of their long-term thinking, are they do they understand this problem more than other governments?
Yeah, I should add that the description I've just given is a normal sort of investment progress. Gold has this additional factor that ahead of the speculators, you've got central banks who begin to look at their reserves and the balance of reserves and all the rest of it, and they start adjusting things. Now, it is a common statement that the central bank of China, the People's Bank of China, has been buying gold. That's not the way to look at it. Actually, what they've been doing is dumping dollars. Now, that, if you understand the difference between the two, it tells you something extremely important. And this is in common with all the other central banks. And remember, they've been told by Vladimir Putin, who's had his reserves stolen by us, don't trust the West, don't trust their currencies, buy gold. He's pretty much said that. And so you sort of think, these guys, I tell you, the central bankers I've met are actually pretty cute. Most of them do understand, sort of, if you like, the outcome for the purchasing power of foreign currencies, etc., etc. It's just they're not in a position really to do anything about it themselves. But the fact that central banks continue to buy gold, in fact, they're pretty much cleaning out all the mine supply, tells you quite simply that these guys really are in the know. They're ahead of the speculators. The speculators can see it, so they go and buy. The poor old swaps and bullion banks, find that they're getting squeezed. I feel so sorry for them. I'm going to cry bitter, bitter tears. But I don't think we need to dwell on that too long. But no, I think it is a very, very important point that what the central banks are doing is they're not buying gold, they're selling fiat currencies, because they understand the difference between money without any counterparty risk and currency with counterparty risk. So what they're telling us is, hold on, this whole system is looking a bit dangerous. Let's put it that way.
Yeah, that's an interesting way to definitely reframe it. Alistair, how do you think that if the tariffs that Trump has laid out, if they're implemented in that way, does that spur more central bank buying around the world of gold to diversify, or as you said it, to get rid of dollars in favor of gold?
Well, I believe it will, because put yourself in the shoes of a foreign central banker. I mean, he'll be looking at the effect of the tariffs on the consumer price index. He'll be looking at the effect of the tariffs on the consumer price index, and he'll be looking at the budget deficit and how that's inflating the whole thing, deflating the purchasing power of the currency by inflating its quantity, yeah, I mean, so he will do that thing which I was talking about earlier on. He will look at, what am I getting actually paid, let us say, by holding US treasuries? And, what's going to happen to the purchasing power of the currencies over the period which I hold them? Mm-hmm. And if it doesn't stack up, he's going to continue to sell dollars. Now, does he go and buy another currency? The answer is no. Because, as I keep on quoting Steve Hanke, because I think he's got such a good turn of phrase in this. He says that the dollar is the least dirty shirt in the laundry. Mm-hmm. And he's right, because the other currencies, if the dollar goes down, the other currencies go down even quicker, as we're seeing at the moment. The dollar is going down against gold. And if you look at the other currencies, they're going down even faster against gold, which means that they're also going down against the dollar, which is why the dollar's trade weighted is suddenly in a fantastic gold market. And it's got a lot further to go on technical considerations alone.
Another way that I was thinking about, let's say, trying to conceptualize this bull market, if you will, in gold, is by looking at silver as well, Alasdair. Do you see this, let's say, the underperformance, as many people expect silver to be, higher than it is currently? Does that underperformance also give us a clue that we're still early in this bull market as well?
That's an interesting point. I think you could be right to look at it that way. It is extraordinary that here we are in, as you put it, a gold bull market, and the gold-silver ratio is looking at 89 times. Mm-hmm. I mean, normally I would expect silver to rise at about twice the rate, maybe slightly less than twice the rate that the gold price does, and it hasn't. Now, it has actually performed more or less in line with gold, but what's happened is that this is because the gold-silver ratio has remained very, very high. I think we've got a problem here because if you go way, way, way back, silver, obviously, I mean, you had currencies which were exchangeable for silver. Sterling was one of them, for example, until Isaac Newton came along and things changed a little bit then. And also in America, I mean, that was the initial currency there. The money, rather, that was the initial money against which banknotes or bank deposits or whatever were issued. It is no longer like that. I mean, in our lifetimes, we've seen silver coins. At least I have. I don't know how old you are. I'm not going to ask. And we've also
I have a couple old silver coins that are much older than me, Alasdair. So well, I have seen them.
But when coins, you had silver coins and copper coins, and those were two monetary metals. Mm-hmm. So we have to ask ourselves, okay, if we have, we start moving towards a collapse in the purchasing power of currencies, which we are already, incidentally, are we going to be in a situation where silver is going to come back, let us say, for small transactions? I mean, silver in Britain was legal tender for up to 40 shillings, which was £2. So there was a legal tender involvement there. I suppose it's still the case, but £2 is absolutely nothing. If you go back to the gold standard, we could exchange £1 for one sovereign. So under those circumstances, 40 shillings was the equivalent of two sovereigns. 2 sovereigns today is £1,100. Give you an idea as to how. So what's happened is that silver has effectively been devalued out of the monetary system completely, through no fault of its own. But there is a huge shortage of silver, and somehow they're managing to manage the price. I think you need to be an industrialist. You need to be a specialist in understanding how technology is changing and how that affects, say, silver versus lithium, and all the rest of it, and future uses, defense uses, which we're not really told about. I mean, this is a metal with huge properties. I mean, it is the best electrical conductor. It is an excellent biocide. And it's finding new applications the whole time. So this is a very, very precious metal. It is not much more around, if you like, as a commodity in the Earth's surface. It's not that much more than gold. I mean, I don't know what the ratio is. I think something like 8 times as much silver, if you like, in the world is estimated compared with gold. So why are we on 10 times that ratio with a gold-silver ratio of nearly 90? It looks like it's being mispriced to an extent. Now, I don't think we go back to the sort of 14, 15 times that we saw when silver was actually valued as real money. But what I do see is that at some stage there could be a huge, great squeeze on the silver price, probably triggered by a rise in the price of gold. I mean, if gold starts rising and breaks into new high ground against the dollar, in other words, the dollar is definitely tanking, then silver is going to be, moving up with all the other commodities. And actually, if you look at the broader commodity complex, it's up reasonably well. It's doing quite well. Gold reflects this. So, we've got the whole of gold is, if you like, leading the way in that context, and it's going to take silver with it. But I think that at some stage, and it's not monetarily related, I think we're going to see a big squeeze on silver, huge, great squeeze on silver. Now, do bear in mind that when we get a credit collapse, this is going to be a Western phenomenon. I would assume, and it is an assumption, that Russia and China will protect themselves from a collapse in the dollar by going back on a gold standard. They have got the gold to do it. And furthermore, they can manage the situation, so they will always have gold reserves. Now, that being the case, then there are ambitions for the whole of Asia, the Shanghai Cooperation Organization, and BRICS member countries as suppliers of commodities and raw materials, foodstuffs, and all the rest of it. Equally important means that over half the world's population, I think, will be in a longer-term industrial revolution, bringing their living standards up as ours is collapsing. So that the demand for commodities, for silver, etc., is going to continue, despite the fact that we're going to be as poor as church mice and not be able to afford to do things because nobody is going to buy it in our, we can only do things which we can export to China, which actually is an interesting take, because here we are lambasting China for undermining our industries by cheap exports, whereas it could actually turn the other way around. We find that we try and export to China and they say, "Ooh, hold on." Anyway, sorry, I digress. That's too much.
Yeah, I think that's always a double-edged sword. We're going to charge you tariffs, but what does the reverse of that look like?
Well, exactly. This is what happened with Smoot-Hawley. I mean, it was tit for tat. You're going to raise your tariffs against me. I'm going to raise mine against you. Politicians are, they're not necessarily stupid. They're motivated completely differently from those who have economic priorities. And consequently, they will always take rubbish decisions. They will bring in, sort of price controls. When actually, if you talk to them, they know jolly well it doesn't work. They say, look, we've got no alternative. They're looking at their short-term survival. They can always blame it on someone else when the thing goes wrong. So, they're under great pressure to do things which are just economically stupid. And don't assume that nice Mr. Trump is completely immune from those pressures.
Mm-hmm. Alasdair, I've heard so many times that the silver market is drastically undersupplied, that we're in this gigantic deficit.
Yeah.
And, that doesn't seem to manifest in the market. So do you have any idea of a particular catalyst or situation where that ends up being recognized by the market?
Well, as I said, I think when gold starts appearing to race away, and it's accepted that gold is going higher, I think at that stage, silver will really motor. Mm-hmm. So, I mean, when I look at it today, we've got gold is up 1.1% and silver is up 0.92. No, 0.85. Sorry, I haven't got my glasses on. Really, if gold is up 1.1, I would expect silver to be up 2%. Mm-hmm. That's the normal relationship. And it's got very much left behind recently. Having said that, I think it's actually formed a pretty good basing, sort of pattern on the chart. And I think that it's only a matter of time when it sort of breaks out. And when it does, I think it's going to run quite quickly. I really do. So I think, the nature of these things is that when everybody's lost patience in it, and the weak holders have decided, oh, God, I can't stand this anymore. I can deploy my assets more effectively. Then it runs. Then it's good. So we're probably not quite there. We've got a lot of stale bulls in silver, let's face it. Which I think is why you're asking the question, actually.
Well, it's just, we hear these narratives presented, and then, it makes everybody hopeful, and yet we don't see the actual outcome of the situation that so many people have been told how this is going to play out. Yeah. So it's just, I try to gather different data points or different explanations as to why and how that could actually end up happening.
Sure. I think, Tom, there is another story, I think, behind this, and that is that the gold price has been rising basically by foreigners, and we're talking about central banks, if you like, national wealth funds, ultra high net worth individuals in Asia and all the rest of it. Well, there's a lot of them now. Mm-hmm. They're buying gold, and they're buying gold for the reasons which we've been discussing. Silver is not part of that story. You'll never see a central bank buying silver. Oh, forget it. It's no longer, as far as they're concerned, a monetary metal. If you're going to protect yourself, you want to protect yourself with gold. But there will come a point, I think, where a degree of moneyness will return to silver. But it's probably when the gold price goes a bit higher and everybody recognizes that this is a story they missed, then you'll find that people will be getting into silver on the basis that gold has already run and silver has yet to run, mm-hmm. as it were. So I think it's going to happen. So, I never give investment advice, but if I was giving investment advice, I would suggest that patience is the watchword.
Well, I think damn near everybody in the gold and silver space has realized that patience is a key virtue right now.
Yeah. Mm-hmm. Yeah. But it's all about, as I say, looking at it in terms of human behavior with financial instruments, stocks, whatever. You really do have, I think it's a situation that's been very, very much controlled. But quite a lot of people have bought silver on the basis that gold has already run away, sort of thing. Now, I'm talking about people who are more sort of, let's say, gold bugs, silver bugs, in that space rather than mainstream investors. As I say, the mainstream investors haven't bought this at all yet. Mm-hmm. And it's because of the nature of what is happening, which is I think, happening really quite rapidly, the destruction of fiat currencies and their purchasing power, that silver has just not been part of the story. It really hasn't. But when, I think, as I say, when gold starts rising, when it starts hitting new high ground, I would expect silver, if gold continues like this, we'll see silver catch up. Some days it'll be up 3% or something. And I think particularly when it gets through that sort of 35 level, $35, that is, I would see it racing away quite quickly, driven by a rising gold, because it will be so much left behind. And this level of the gold silver ratio seems to me to be completely crazy. And I would expect that to drop certainly down to the 80 level, and if it breaks that, we could be then looking down to 70 or something like that. So it's got the potential, I think, to have quite a bit of catch up, but it's probably going to lead a few more days of gold doing this, really, for that to shine through.
Mm-hmm. Excellent, Alasdair. Well, I appreciate you coming back on to explain your views on this stuff for us. Is there anything that you'd like to leave our listeners to think about before we wrap up today?
Yeah, think about this is the biggest credit bubble in human history. Think about that. Think what happens when the bubble pops. And when the bubble pops, you will understand why interest rates are going up, because there is so much risk in credit, which ordinary people just do not yet realize. Mm-hmm. Central banks realize it, which is why they're getting out of credit. So, get out of credit, I think, is a sensible thing to do. Mm-hmm. I'll leave you with that thought.
Excellent.
And I'm sorry about the coughing. I really am.
Understandable. It's a natural part of the human condition, I guess, sometimes.
Unfortunately.
Of course, Alasdair, you do a lot of writing, a lot of excellent articles, all available at alasdairmacleod.substack.com, and of course on Twitter or X at Macleod Finance. Alasdair, thank you so much for your time today.
Thank you for having me on, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.